Soumya.
Thank you.
Okay. See, today actually we have to start the configuration. Now, before starting the configuration, we have to understand ledger concept in S/4HANA, because there are huge changes in the ledgers in S/4HANA when compared to ECC 6.0. So basic settings and all these things are common only, right? There are no any changes in the configuration of chart of accounts, posting bit variant, little bit changes are there. Then company code, fiscal year variant. In fiscal year variant, little bit changes are there. But whenever, as far as the ledgers are concerned, there are many changes in the concept of ledgers as far as configuration is concerned and functionalities are concerned. And also in S/4HANA, there are new types of ledgers are introduced. So what is that ledgers in S/4HANA? So I will compare the differences of ledgers between ECC and S/4HANA. Basically, what is the purpose of these multiple ledgers? Why we have to have the concept of multiple ledgers in SAP and even in non-SAP also, why we have to maintain books of accounts according to different accounting principles. Say for example, basically what is accounting principle? Accounting principles are uniform practices which entities follow to record, prepare and present financial statements. An entity must prepare its financial statements as per acceptable accounting principles in order to present true and fair view of state of affairs of the entity. Here, entity means company codes. Here, nowadays, every business enterprise is operating globally. That means, right, you have the number of shareholders hailing from different countries. So different countries' perspectives are entirely different, right? So as far as financial statements are concerned, these financial statements are to be analyzed by the shareholders, most probably, right? Of course, we have to submit the financial statements legal authorities. That is entirely different issue. The most important thing is the financial statements are to be understood by your shareholders compulsory, because these are the shareholders who are invested in your company and your shareholders are spreading all over the world. So in that case, if you prepare your financial statements in your own way, right, they cannot be understood by the shareholders. That's why you have to follow some rules and regulations in presenting your financial statements and in the maintenance of your books of accounts, right, and the way of preparing your financial statements also. So these rules and regulations are called accounting principles. So these rules and regulations will govern in what way you have to maintain the books of accounts, how you have to process your business transactions, what is the accounting treatment you have to give to many business transactions. So all these parameters are maintained uniformly. So these are called accounting principles. So every country has its own accounting principles. And in addition to that, there is international accounting standards, right? So when you're doing business in a specific country, you have to follow the accounting principles of that country. But when you're doing the business internationally, right, then also you have to follow your international accounting standards in addition to your country-specific accounting standards. So here in India, the general accounting principles are accounting standards. So the accounting principles are also called accounting standards and Indian accounting standards. So in India, they are called Indian accounting standards. You might have heard about the IAS. IAS means Indian accounting standards. So uniform accounting principles assist in the comparison of financial statements of entities. If accounting principles followed are same, then the reader of financial statements can compare the financial results of two entities. Suppose in India, you have the two company codes, company code A and company code B, and both the company codes in the same nature of business, and both the company codes have to prepare the financial statements. And while preparing these financial statements, they have to follow them same procedures and principles, so that the shareholders of both the company codes can compare the performance and they can analyze which company is performing better. not only two company codes, all the company codes operating in India, they have to follow the same principles and standards so that the analysis is easy for the shareholders. However, if separate entities follow different accounting principles, they should at first prepare financial statements as per the same accounting principles, and then readers should make a comparison. So that is the meaning of accounting principles. So accounting principles means common accounting standards, common accounting procedures in which the books of accounts are maintained and presented to the shareholders. Then accounting standards are the written documents and policies that provides principles for recognition, measurement, treatment, and presentation and disclosures of accounting transactions in the financial statements. For example, the accounting standard on inventory will provide the principles on certain criteria on the basis of which the inventory is recognized and what all costs will form part of the inventory. That means, suppose when you follow different accounting principles, why we have to follow basically different accounting principles? Because you are doing business in many countries. So you have to follow the accounting principles of those respective countries. Then in some of the countries, right, the inventory is valuated at the invoice price. Inventory means inventory of raw materials, packing materials, stores and spares, right? So the inventory of raw materials is valuated at invoice price. But in some accounting principles, the invoice price plus freight inward is to be included in the inventory cost. In some other countries, right, the invoice price, right, plus inventory, the invoice price plus freight inwards and any other purchase order costs also. So like that, the valuation of inventory may differ from country to country. That is accounting principle to accounting principle. And the recognition of fixed assets value, right, is also may also differ from accounting principle to accounting principle. So when the fixed assets valuation differ from accounting principle to accounting principle, the depreciation calculation and the amount of depreciation also differ from accounting principle to accounting principle. In some countries, right, suppose you have taken one term loan, right, to purchase the fixed asset. The term loan you have taken in foreign currency. Say, for example, you have imported one plant and machinery from USA. So in order to purchase that plant and machinery in US dollars, you have taken one term loan. So when you have taken the term loan, right, periodically there are fluctuations in the foreign currency loans. Sorry, in the foreign currency rates. Then periodically this foreign currency is to be evaluated. I mean, the foreign currency loan balance is to be evaluated in order to recognize the fluctuations in the foreign currency rates. So in some accounting principles, we have to take into consideration the acquisition value of the fixed asset plus exchange rate differences. If the exchange rate increases, that exchange rate is called loss, and that has to be added to acquisition cost of the asset, and on that value, the depreciation is to be calculated. In some other accounting principle, right, it's not necessary to take into consideration the fluctuation in the foreign currency rate. The depreciation is calculated on the invoice value of the fixed asset. Like that, the fixed asset valuation also may change from accounting principle to accounting principle. That's why when you're doing the business internationally, you have to maintain your books of accounts according to different accounting principles. For that purpose, we need to maintain different sets of books of accounts. See, for example, the accounting standard on inventory will provide principles on the criteria on the basis of which the inventory is recognized. What all costs will form part of the inventory, how to treat those costs, and how to how to present the inventory in the financial statements and relevant disclosures. Just 1 second, sorry for the interruption. So in India, right, these accounting principles and accounting standards are regulated by and are formed by Institute of Chartered Accountants of India, right? So till now, Institute of Chartered Accountants of India has declared nearly 27 accounting principles or accounting standards in total. So based on the right, the social conditions also, right? These regulatory bodies, they design the different accounting principles also. As the time passes, right, they will come up with new accounting policies and new accounting standards also. So these accounting standards are recommended by Institute of Chartered Accountants of India and becomes applicable to entities only when the central government notifies it. Here, these accounting standards are formulated by Institute of Chartered Accountants of India. Then the central government of India has to approve it. Unless these accounting standards are approved by the central government, they cannot be enforced, right? So currently there are 27 accounting standards in total. Then in US, right, these accounting standards are called US GAAP, means generally accepted accounting principles. GAAP, generally accepted accounting principles. So these generally accepted accounting principles, right, are designed by FASB. That is nothing but Financial Accounting Standards Board, USA. Similarly, UK GAAP is also there. So in UK, right, all the companies which are doing the business, they have to follow UK accounting standards. They are called generally accepted accounting principles UK, or simply they are called UK GAAP. Then there is one more accounting standards, IFRS, International Financial Reporting Standards. So these IFRS standards are to be followed by multinational companies. So when you're doing the business in different countries, right, then only you have to follow this IFRS. Suppose you are doing business in UK, right, India, China, Japan, Malaysia, etc. So basically you are from UK. Then first of all you have to prepare the financial statements according to UK Companies Act, that is UK accounting standards, for which you maintain one set of books of accounts. Because you are doing international business and you have spread yourself internationally, you have to follow IFRS accounting standards also. But the valuation of fixed assets and the valuation of inventories and consideration of bad and doubtful debts according to IFRS and UK GAAP are entirely different. So you cannot maintain the same books of accounts. You have to maintain another set of books of accounts according to IFRS regulations. Means you have to maintain another set of books of accounts according to IFRS regulations. Like that, you may have to follow different accounting standards. To meet the regulations of different accounting standards, you have to maintain multiple sets of books of accounts. I hope it's clear for everybody. Because I'm coming from the scratch, right? Then compliance with different accounting standards or principles. So compliance with the different accounting principles is necessary in the case of companies which are having international presence. To comply with different accounting principles, we need to maintain separate set of books of accounts according to each accounting principle. Each set of books of accounts is called parallel ledger or parallel accounting. So whatever the software you are using, it is relevant for you, right? You have to maintain the books of accounts according to your legal requirements. If you are doing business in only one country legal requirement compliance is enough. But you're doing business internationally, multiple accounting principles you have to follow. Whatever the software you use, it is your will and wish. But as far as reporting is concerned, you have to report. If you are an international company, you have to report according to multiple accounting principles. And if you're doing business in only one country, you have to follow that country specific accounting principles. So in SAP, in order to meet these accounting requirements, we have two approaches, right? One is accounts approach. This is also available even in ECC also, right? So till now, it is a general discussion regarding accounting principles and why we have to maintain different sets of books of accounts. So in order to meet the requirements of different accounting principles, right? You need to maintain separate set of books of accounts, or you need to maintain different sets of books of accounts. In order to meet these different accounting principles requirements, in SAP, we have the two approaches available. One is accounts approach. Number two, ledger approach. Just 1 second. Yeah, I'm sorry for the interruption. So in SAP, in order to meet the legal requirements of different accounting principles, right? SAP provides two approaches. One is accounts approach. Number two, ledger approach. Generally, we don't follow accounts approach. So these two approaches are available in ECC 6.0 also. From ECC 6.0 onwards, right? Before ECC 6.0, in order to meet the requirements of different accounting principles, we have one concept, special purpose ledgers. Now the special purpose ledgers is obsolete from ECC 6.0. So in the accounts approach, what happens is, in this approach, we maintain set of GL accounts according to the accounting principles of the home country of the company code. This is called common GL accounts. So any number of accounting principles you need to follow. There are some common set of GL accounts. So those common set of GL accounts, right, are maintained. Then there are some exclusive GL accounts to be maintained according to different accounting principles. Then these GL accounts are also maintained in the same set of GL accounts. So additional separate GL accounts are maintained as per other accounting principles. Then the financial statements are prepared from the common GL accounts plus additional separate accounts according to each accounting principle. That means so our company code is in India, right? So we have IAS, Indian Accounting Standards. Indian Accounting Standards, right? So in addition to that, you have to follow IFRS, then UK GAAP. So these are the three accounting principles you have to follow. You are doing business in India, right? So first, according to IAS only, we maintain the books of accounts, right? So according to IAS, you maintain common set of accounts. Then for the IFRS, you maintain separate GL accounts. Then for US GAAP also, you maintain the separate GL accounts exclusively to UK GAAP. Now, when you prepare your financial statements according to IFRS, right? IFRS financial statements, is equal to common set of accounts plus separate GL accounts as per IFRS. That's all. This is called account approach. Suppose UK GAAP financial statements is nothing but common set plus separate GL accounts for UK GAAP. So where do we assign this GL accounts? In the financial statement version, right? So in the financial statement version, you have one function, right? Assignment of GL accounts. What you are doing there, you are keeping the cursor on every heading and you are assigning, you are clicking on assign GL accounts. There you are assigning the account numbers. During that assignment, right, you can assign the separate set of GL accounts also. Common set of GL accounts and exclusive set of GL accounts according to your specific accounting principles. But generally, we don't use this accounts approach. Clear for everybody till now? Then next one is ledger approach, very much used, right? See, ledger means ledger represents set of books of accounts. One set of books of accounts is called ledger. Then each ledger represents one set of books of accounts. You maintain one set of books of accounts according to IAS. That is called one ledger. You maintain separate set of books of accounts according to UK GAAP. That is called one set of books of accounts or ledger. You maintain separate set of books of accounts according to US GAAP. That is called one ledger, nothing else, very simple. So ledger represents one set of books of accounts. So in ECC, we have the two types of ledgers, leading ledger and non-leading ledgers. These things, two things you know, right? You have configured already. Leading ledger and non-leading ledger. Then, so all the previous slides, right, and these slides I will send you today after the class. So leading ledger. It is a set of books of accounts maintained according to legal requirements of the accounting principle of the home country of the company code. And all the company codes are linked to the leading ledger automatically when the company code is defined. That means you are doing business in India. So first you have to follow Indian accounting standards or Companies Act requirements. For that purpose, you maintain one set of books of accounts. That set of books of accounts is called leading ledger. Similarly, you are doing business in UK. So you have to maintain the books of accounts according to UK GAAP or UK Companies Act. So that set of books of accounts is called leading ledger. So whatever, and you are doing business in USA, you have to maintain the books of accounts according to USA GAAP requirements. Like that, the books of accounts which you maintain according to accounting principle of the home country of the company code is called leading ledger. And the leading ledger is represented with 0L. It is already defined in the system. When you create the company code, whatever may be the country with we are creating the company code, maybe US company code, UK company code, Indian company code, whatever it is. When you create the company code, the system automatically assigns the leading ledger to the very company code, right? And one leading ledger is assigned by system to all the company codes. So this leading ledger is defined at client level. It's a client level setting. You don't define, right? 0L was already defined in the system. So when you create a company code, the system assigns this leading ledger to every company code. And the CO module and logistics modules are integrated with the leading ledger only. See, the CO module and logistics modules are integrated with the leading ledger only. You know, right? You have done some postings, right? In FI. So whenever you post expenses in FI, that is nothing but your leading ledger. From the leading ledger, right, you are posting it to cost center accounting, internal order accounting, profit centers, cost objects, etc., right? That means the transactions from the leading ledger only are posted to controlling component. Similarly, when you have issued raw material and you have posted that in the respective GL accounts are updated in FI. What does it mean? The GL accounts in the leading ledger only are updated. That's why the CO module and the logistics modules, and SD, and other modules are also integrated with the leading ledger only. The leading ledger inherits the fiscal year variant and posting period variant from the company code fiscal year variant and posting period variant. So the company code fiscal year variant and the company code posting period variant are automatically assigned to leading ledger only. Clear for everybody till now? Let us come to currencies later on. So the leading ledger fiscal year variant and the leading ledger posting period variant also should be same, right, as with the company code fiscal year variant and company code posting period variant. They cannot have separate ones. Then leading ledger currency types in ECC. So all these things we have done, but you don't know that they have been done for leading ledger only. See, there are two scenarios as far as leading ledger currency types are concerned. Number one, when multiple valuations are not used. Number two, or the scenario two, when the multiple valuations are used. So what is multiple valuations? First, let us try to understand what is multiple valuations. Then we will see what are the currencies you can use when the multiple valuations are used and the multiple valuations are not used. Okay. So it is the valuation of inventories mainly, right? Multiple valuations are based on the valuation of inventories defined according to different purposes. It is the valuation of inventories according to different purposes. There are 4 types of valuations available in SAP, but we can use only up to maximum 3 valuation types, right? Even though there are 4 valuation types available, we can use only 3 valuation types. So what is number 1, legal valuation. Number 2, group valuation. Number 3, profit center valuation. Number 4, parallel valuation of COGM. COGM, parallel valuation of actual COGM. So COGM is cost of goods manufactured. Then what is legal valuation? The valuation of inventories according to the legal requirements of the home country of the company. You are doing business in India, right? So in India, right, we have IAS, accounting principles, or companies act requirements. According to this, right, you have to evaluate your inventories. Inventories of raw materials. Remember, inventories includes always raw materials, finished goods, packing metals, etc., etc. So according to IAS, right, the inventories of raw materials, packing materials, stores and spares are to be evaluated at procurement cost or moving average price. Not only in India, generally in every accounting principles, right? The inventories of raw materials are to be evaluated at the moving average price or procurement cost. Then finished goods inventory is to be evaluated at standard cost. So where do you find where you are finding out the standard cost? In which module you can find out the standard cost? Any answer from anybody? Forecast planning. We have seen now. We have calculated the standard cost, and when we have transferred the finished goods inventory to When you transfer the finished goods inventory from plant to finished goods warehouse, that was valuated at the standard cost only. And the inventory of the finished goods are also valuated at standard cost only. And the standard cost is updated in the costing 2 tab of finished goods master record. From there, the system picks the value. So the legal valuation, not only in India, generally named according to any accounting principle, right? According to any accounting principle, the inventories of raw materials are to be valuated at procurement cost or moving average price. And the finished goods inventory is always valuated at production cost or standard cost. So for legal valuation, we can use the company code currency always 10. We use always company code currency 10. Here, this company code currency 10 was already defined in the system. Whatever the currency you assign to your company code, that is represented with 10 only. Then group valuation. See, the group valuation concept is used for the purpose of preparing the consolidated financial statements, that is consolidation purpose. For this purpose, the intercompany profits are eliminated, which are included in the inventories of the company codes. The elimination of intercompany profits included in the inventories is necessary when there are intercompany transactions. Say, in OB22, I hope everybody remembers OB22. See, here currency type 10, company code currency. First local currency is always company code currency. So the company code currency is used for the legal valuation. According to legal valuation, the financial statements are presented and prepared only in the first local currency. Suppose in the currency type, if you press F4, see, 10 company code currency, 30 group currency, 40 hard currency, 50 index based currency, 60 global company currency. So, see, a company code can use up to 3 currency types. I hope all of you will remember all these points. I explained you these things in your group currency in your ECC. So, what exactly is the group valuation here? What exactly is the group valuation? Why intercompany profits exist in the group valuation? Why we have to eliminate intercompany profits in the group valuation? Let us take one example. You have AB group. So, company code A, company code B. You have the company code A and the company code B. Now, this company code A is manufacturing product X. Then this company code B is manufacturing product Y. Okay. Now, This product X is the raw material for product Y. Product X is the raw material for product Y. Till now clear? Now, the cost of production or COGM is 100 rupees. The cost of production per unit of product X in the company code A is 100 rupees. Now you are preparing the financial statements for company code A. At what rate the inventory of finished goods is evaluated? 100 rupees only, right? This is called legal price. For preparing legal financial statements, you are using this price. This is called legal price. Still no clear? Now, product X is also the raw material to product Y, which is manufactured in the company code B. So that's why this company code 1 is also supplying product X to company code B. Right? Now, this company code A is selling this product X to its customers at 150 rupees. Now, this company code A is also selling this product X to company code B, which belongs to same group. In that case, product X cannot charge 150 rupees from company code B also. So let us say company code X, company code A is charging 130 rupees. ₹130 per unit. So this company code A has supplied 1000 units to company code B. Today we are preparing the P&L account and balance sheet for company code B. So for company code B, this product X is the raw material, right? For company code B, this product X is the raw material. So today we are preparing the P&L account and balance sheet for company code B. It is the raw material. At what price? That raw material inventory has to be evaluated at the procurement cost. Getting the point? So that means this is the legal price. This is the legal price for company code B, because legal evaluation is done with 130 rupees per unit. So for company code A, legal price is 100 rupees, its cost of production. For company code B, legal price is 130 rupees. 130 rupees is the price at which company code B is purchasing product X from company code A. Till now clear? Legal price. Now you think as a group. You think as a group. Now we are preparing group financial statements. Group financial statements. Now, in the company code A, you have inventory of product X, 1000 units. In the company code B also, you have inventory of product X, 1000 units. So total inventory of product X from the group point of view is 2000 units. Now, the inventory of product X in the company code A is to be valued at 100 rupees only, because that's the legal price. Now coming to company code B, you cannot evaluate the inventory of product X in the company code B at 130 rupees. It's unrealized profit. In the company code B, it's unrealized profit. So actually, in company code B also, product X quantity is to be valuated at 100 rupees only. Getting the point? So in this case, in company code B, product X is to be valuated at 100 only. That means legal price for company code B legal price company code B 130 minus profit of company code A. How much is that? 30 rupees. That is 100 rupees. This is called group valuation. This is called group valuation. Clear for everybody? If anybody wants, I will explain again. This is called legal valuation. Sorry, group valuation. So in the group valuation, right, we have to eliminate the intercompany profits which are available in the unsold stock or unused stock. This is the concept of valuating the inventory for the group purpose. Clear for everybody? So the elimination of intercompany profits included in the inventories is necessary when there are intercompany transactions. Suppose if there are no intercompany transactions, there is no necessity to eliminate intercompany profits, right? That means in case product company code B has purchased product X from outsiders, then its inventory cost will be total quantity of inventory into procurement cost or moving average price. I hope it's clear for everybody. Then profit center valuation. This is the third valuation, right? It is the valuation of inventories in the profit centers. The inventories of the profit centers are valuated with the transfer prices. That is mutually agreed price. For profit center valuation, we can use either company code currency or group currency. That means you have the company code, right? So this company code is producing and selling two products. Product one, right? This is nothing but a profit center one. Then product 2. This is your PC2. Profit center 2. Now, person A is responsible, right, for the performance of product 1, right? Then person B is responsible for the performance of product 2. That means person A is responsible for the profitability of product 1 and person B is responsible for the profitability of product 2. Now, this profit center 1, that means person A is selling some of its products to outsiders, right? So, selling price for customers is equal to 150 rupees per unit. Now, product A is also used as raw material in the product B also. I mean in the product 2 also. Product 1 is also used as a raw material in the product 2. Now, this person A also has to supply, right, this product 1 to product 2 responsible person B. Then at what price? A has to charge from B. Remember, both the products are produced by the same company code, but individual responsibility units. There are separate persons who are responsible for the profitability of the different products. Person A is responsible for the product 1 profitability. Person B is responsible for the product 2 profitability. That's why, right, you have to think from both the persons. Person A cannot supply the goods to person B, right, at the cost price because he is responsible for the profitability of his product. Similarly, person B cannot purchase the product 1 from person A at the price charging to customers. It is too high. So if the B accepts the selling price charged to customers, right, his profitability of his profit center will be reduced. So 150 rupees is not acceptable either to A or B. So they will come to an agreement. Person A and person B, they will come to an agreement. Person A says, I don't charge 100 rupees from you, but I am ready to charge only 125 rupees from you. For that, the person responsible for the product 2 also accepts. This is called markup price. This is called markup price. So, person A charges 125 rupees from person B for product 1. Right? Now, for PC1, I mean for the product 1, COGM is 100 rupees only. This is the legal price for product 1. So in the profit center 1, right, the inventory of product 1 is valuated at the cost price, that is 100 rupees. Now, in the product 2, the inventory of raw material product 1 is valuated at markup price, 125 rupees. This is called profit center valuation because both the profit centers are individually responsible for their profits. But if you consider the inventory of product 1 and product 2 at the company code level, again markup price is to be eliminated. So in the product one, right, profit center one, the finished goods inventory is valuated at 100 rupees per unit, and in the product two, profit center two, the inventory of product one, which is used as a raw material, is valuated at 125 rupees. This is the individual profit center valuation. This is called profit center valuation. Suppose you are evaluating the inventory at a company code level. In that case, in both the company codes, the price is to be taken 100 rupees only. Inter-profit central profits are to be eliminated at the time of valuating the inventory at the company code level. But if you evaluate the inventory at the profit center level, the prices are different. Clear for everybody? It is a little bit tricky. So, in the normal ECC, right, the profit center valuation we can use either company code currency or group currency. Then parallel valuation of actual COGM. What is the parallel valuation of actual COGM? It is the process of calculation of cost of goods manufactured according to different accounting principles. Here, each valuation is called view. Legal view, group view, profit center view. Each view is called valuation, or each type of valuation is called view. So legal valuation is represented with 0. Group valuation is represented with 1. Profit center valuation is represented with 2. And parallel valuation of COGM is represented with 5. So what is the parallel valuation of actual COGM? It is the process of calculation of cost of goods manufactured according to different accounting principles. I told you, when you follow the different accounting principles, right, valuation of fixed assets will be different, because in some accounting principles, the fixed assets are valuated at the acquisition cost. In some of the accounting principles, the fixed assets are valuated at acquisition cost plus differences in the foreign currency loan exchange rates, if you have taken the one foreign currency loan to procure that asset. Like that, when the fixed assets valuation is different, depreciation calculation is also different, no? And also, as far as inventory cost is concerned, there are different accounting procedures to evaluate the inventory also. Let us take one example. Yeah, parallel evaluation of actual COGM. We have the international Indian accounting standards, IFRS, and US GAAP. So one fixed asset you have purchased, one plant and machinery you have purchased, right? So its actual value is 1 lakh, right? Invoice value is 1 lakh. So according to Indian accounting standards, right, your asset value is 1 lakh. But according to IFRS, right, you have to eliminate the gain that has occurred because of reductions in the foreign currency rates. So let us say that foreign currency gain is 10,000 rupees. So the 10,000 rupees is to be eliminated from the acquisition cost. So 90,000. Then US GAAP 95,000. So these are the different valuation of the same fixed asset in the different accounting principles. Then useful life is 4 years according to IAS, IFRS 3 years, US GAAP 4 years, right? Then depreciation for the year. According to IAS, total acquisition cost divided by 4 years, 25,000. According to IFRS, 90,000 total cost divided by 3 years, 30,000. Then according to US GAAP, 23,750, 95,000 divided by 4 years. That is, the depreciation also changes from accounting principle to accounting principle. Then number of hours is 1,000 hours it is working. Then mission hour rate or depreciation per hour is 25,000 divided by 1,000 as per the IAS, 25 rupees, right? Then according to IFRS, depreciation is 30,000 depreciation divided by 1,000 hours, 30 rupees. According to US GAAP, total depreciation 23,750 divided by 1,000 hours, 23 by 75, 23.75. This is the depreciation per hour, right? Then we are using raw material X. We are purchasing raw material X. So in IAS, right, according to Indian accounting standards, the raw material is evaluated at the invoice price or procurement cost. Let us say that is 100 rupees. But according to IFRS, right, the raw material the raw material purchase price can include freight charges also. So freight charges is 5 rupees per unit. Let us say 105 rupees. And US GAAP also same principle. Freight is allowed to be included in the raw material cost. Now we are producing, right, finished goods X. In order to produce 1 unit of finished goods X, we require raw material X, 1 kg. So what is the cost per unit of raw material according to IAS? 100 rupees. What is the cost per unit of raw material according to IFRS? 105 rupees. What is the cost of raw material per unit according to US GAAP? 105 rupees. Then what is the depreciation? That is mission hour rate or depreciation. According to IAS, 25 rupees per hour. Let us assume you take 1 hour to process this 1 unit of finished goods X in the plant and machinery. So 25 rupees under IAS, 30 rupees under IFRS, and 23.75 under US GAAP. Then what is the cost of production under IAS? 100 rupees per 25, 125 rupees. And what is the cost of production under IFRS? 105 plus 30, 135. Under US GAAP, 105 plus 23.75, 128.75. This is called parallel valuation of COG, cost of goods manufactured. Clear? So these are called parallel valuations. So when you don't implement or when you are not using any parallel valuations, right? In the leading ledger, right? Leading ledger currency types in ECC. When the multiple valuations are not used, a company code can be assigned with maximum 3 currencies. That is in OB22. There is no parallel valuation. You are using only one ledger, that's it, 0L. In that case, you can configure up to 3 currencies for your company code. Or you can say 3 currency types, right? Clear, no? That is first currency. It is the company code local currency. It is the currency of the home country of the company code. This currency is defined at the time of defining the company code. This is represented with the number 10. Here see, first local currency, company code currency 10. Then second currency. It is preferably group currency. So you have configured group currency for your company code, right? With the type 30. It is the currency defined at the client level. It is represented with the number 30. See here, group currency 30 means, currency type 30 means group currency. So this group currency is defined at client level. See, SCC 4. So client 800 details. Standard currency, group currency, euros. Okay. So here, group currency, euros. Then third currency type. So you can use third currency type also. See, when you're not using multiple valuations, means you are using only one accounting principle. In that case, you can use up to 3 currency types. Third currency. It can be preferably hard currency or index-based currency. It is used for the reporting purpose only. Hard currency is 40 and index-based currency is 50. The hard currency and index-based currency are defined at country level. Say, for example, you can define our own countries, SAP NetWeaver, general settings, set countries, define countries in my SAP systems. Click on position, country IN, click on enter, select IN, click on details button. Sorry, not this one. Currency. I forget the path. Hard currency and index-based currency are defined at the country level. Not this one. Okay, I will show you where we can define that hard currency and index-based currency at the country level. Tomorrow, in tomorrow's class, I will show you. I forgot the path actually. So when we don't have multiple valuations, we can use all the three currencies for the legal valuation only. So when you don't have multiple valuations means you are using legal valuation only. Till now clear? And these currencies are defined in OB22 transaction code here itself. Till now clear for everybody? Then scenario 2, when the multiple valuations are used. Here, in this case also, we can use three currencies, not currency types. Please remember, currencies are different from currency types, but we can use only two currency types. First currency, always legal valuation, right? It is always company code local currency. It is the currency type 10. It is used for legal valuation. Then second currency, it is group currency. It is the currency type 30. This currency is used for group valuation. Third currency, this currency can be either company code currency or group currency. Third currency you can use, but that third currency should be either first currency or second currency. That means company code currency or group currency. It cannot be other than these two currencies. This currency is used for profit center valuation. And these multiple valuations I explained you already. Right? Now let's have a break of 10 minutes. Then we will come back and we will see. Yes, I am back. Akshita, are you there? Ali, Avinash, Chandan.
Yes, sir.
Okay, Ranganath, Sachin.
Yeah, I can hear, sir.
Okay,
Yes, sir, I'm here.
okay. Soumya.
Yes, sir.
Okay. Charles.
Yes, I'm there.
Okay. Let's wait for 1 more minute. Let others also come. Avinash, Ali. Okay. See, non-leading ledgers in ECC.
Yes, I am here.
Yeah, okay. So we are discussing the ledger concepts in ECC only. So the ledgers are set of books of accounts maintained to meet the requirements of the other accounting principles is called non-leading ledgers. So your company code is in India. So you have to prepare the financial statements according to Indian accounting standards. For that, you maintain the books of accounts. That is called leading ledger. Then you have to present your financial statements according to UK GAAP and IFRS accounting principles. According to these two accounting principles, we maintain a separate set of books of accounts. These set of books of accounts are called non-leading ledgers or non-representative ledgers also. For each accounting principle requirements, we maintain one non-leading ledger. Each non-leading ledger can be assigned to multiple company codes. Remember, always the ledgers are defined at the client level. So we can assign one non-leading ledger to multiple company codes also. And see, each non-leading ledger can be assigned to multiple company codes. And each company code can have multiple non-leading ledgers. Suppose if a company code is having in India, leading ledger, Indian accounting standards, non-leading ledger number 1, IFRS accounting standards, non-leading ledger number 2, UK GAAP accounting standards, non-leading ledger number 3, US GAAP accounting principles or standards. Like that, one company code can maintain any number of non-leading ledgers, but they can have only one leading ledger. A company code cannot have more than one leading ledger. Separate fiscal year variant and posting period variant can be assigned to each combination of company code and non-leading ledger. See, suppose for example, you are in India. So our leading ledger is following Indian accounting standards. In India, fiscal year is April to March. So for the leading ledger, fiscal year variant is V3. And you have to prepare the financial statements according to US GAAP accounting standards. So for US GAAP accounting standards, the fiscal year is January, December. So for the non-leading ledger US GAAP, you can have a separate fiscal year variant. And also you can have a separate posting period variant also. The leading ledger fiscal year variant and posting period variant are similar with the company code fiscal year variant and the company code posting period variant. But as far as non-leading ledgers are concerned, they can have separate fiscal year variant, separate posting period variant from the company code. But it is possible to assign the same posting period variant for each combination of company code and non-leading ledger. That means non-leading ledger K1, K2, K3, company code ABC1, ABC2, ABC3, fiscal year V3, V6, K4, and posting period variant X1, X2, X3. That means non-leading ledger can have the same posting period variant and fiscal year variant same with the leading ledger. Otherwise, they can have a separate fiscal year variant and a separate posting period variant. Then non-leading ledger currency types. The non-leading ledgers also should use the same currencies and currency types as with the leading ledger. They cannot deviate from the leading ledger currency types. Non-leading ledgers cannot be integrated with the CO and logistics modules. That means you cannot post the CO transactions and logistic transactions to the specific non-leading ledger unless we assign that non-leading ledger in a ledger group. See, enter GL account posting for ledger group. That means here, sorry, not this one. See, when you create a non-leading ledgers, right? With each non-leading ledger, the system automatically creates one ledger group. I hope everybody remembers the parallel ledger accounting functionalities, right? Anyhow, I'm explaining again. When you create an individual non-leading ledger, the system creates a ledger group with that non-leading ledger. Then, in addition to that, you can create one ledger group which encompasses all the non-leading ledgers and also leading ledger. Say, for example, okay, let us keep it as it is. Let us open one more session. Financial accounting, SPRO, financial accounting new, general ledger account, financial accounting global settings new, ledger, ledgers, define ledger group, right? So, see, we have the ledger group KL, right? So, in this ledger group KL, right? See, we have assigned 3 ledgers. So, 0L, leading ledger, A1, A2, non-leading ledgers. So, a ledger group is created KL, right? So, here, we cannot post the, non-leading ledgers cannot be integrated with the CO and logistics module. That means we cannot post the CO transactions and logistics transactions to the specific non-leading ledger. That means you cannot post the CO transactions and logistics transactions, that is integration, SD integration transactions to the specific A1 and A2. But when you create a ledger group, right, to that ledger group, you can post logistics transactions also. That means for KL. So when you post the transactions to this ledger group, right, then the system will update these 2 individual ledgers also. But as far as FI transactions are concerned, right, you can post the ledger specific also. Because here you have the ledger group. You can give the ledger group A1. In that case, the transaction is posted only in ledger group A1. Suppose if you enter KL, then the system will update the transaction in all the 3 ledgers. That is 0L, A1 and A2. That means unless you create a ledger group, right, the CO transactions and logistics transactions cannot be posted to non-leading ledgers individually. But you can post FI transactions in the specific ledgers also. Because when you create one ledger, non-leading ledger, system creates a ledger group automatically. Clear? That is the meaning of this sentence. It is possible to integrate the non-leading ledger with asset accounting and foreign currency valuation and other integrations. You cannot integrate with the logistic transactions. But other integration transactions, other modules integration transactions, and also asset accounting transactions can be posted to specific non-leading ledgers also. Clear? Then data updations in the non-leading ledgers. At the document entry level, if no ledger group is specified, all the ledgers specific to the company code are updated. All the ledgers which are assigned to your company code are updated. How? See, at the time of posting the transactions, right, you are giving the company code, no? So you assign the ledgers to company code. See, define ledgers for general ledger accounting. Sorry, here, define and activate non-leading ledgers. Ledger A1. This is assigned to company code, no? Similarly, ledger A2. So ledger A2 also assigned to company code only. So at the time of document entry level, if you don't assign any ledger group, then the system will update all the ledgers which are assigned to that company code. Suppose if you enter the ledger group KL, then the system will update the ledgers assigned to this KL ledger group only. Clear, no? Because in S/4HANA, this ledger concept is very crucial, right? For one posting, the system will generate one document in leading ledger and one document in each non-leading ledger assigned to the company code. Suppose you have posted one document, right? In FB01L. See, in F-02, right, it will post only to leading ledger. In F-02, you cannot give any ledger group. If you want to post the ledger group, you have to go to the transaction code, right, FB01L. So in that case, the system will post one document, right, in the leading ledger and in every non-leading ledger assigned to your company code. That's why you define the number, document types and number ranges for each non-leading ledger also. That was done here. Finance accounting new, finance accounting global settings new, ledger, no, not ledger, document, document number ranges, documents in the entry view, sorry, documents in the ledger view, define number ranges for general ledger view. So it is asking for the, sorry, not here, document number ranges in the ledger view. So here we enter the company code. Sorry, here. First we define the document types. No? Document types for entry in a ledger. Document types for entry in a ledger. So here you give the ledger and you define the document types with the numbers. For those numbers, you assign the number range numbers. That means what? In every ledger, right, a system posts a physical document. Suppose you have the 3 ledgers assigned to your company code and you are posting 1,000 transactions. Then the system will post 3,000 physical documents. Clear? And it is possible to post transactions only to the specific ledger. That means here, suppose, right, you can enter A1 ledger group also. A1 ledger contains only A1 ledger. A1 ledger group contains only A1 ledger because when you create A1 ledger, the system automatically creates a ledger group with the same name. That's why it is quite possible to post the transactions to specific ledger also. Clear for everybody? For this, we can enter the specific ledger or ledger group at the document entry level. In that case, the system generates document only in the specific ledger of the company code. See, look at the screen here. SPRO, finance accounting new, finance accounting global settings new, ledgers, ledger, define ledgers for general ledger accounting. So 5, 6, 7, 8, 9. Let us create one ledger A9. Ledger A9, right? UK gap, total stable, FAGL, FLEXT, click on save. See, adding a ledger requires adjustments to be done. Just ignore the message. See, ledger group A9 is created only with the ledger A9. Suppose if you want to post only this ledger group A9, in the ledger group A9, right, you can enter A9. Then that posting is done only to that A9 ledger only, FB01BL. Suppose. If you assign this A9 ledger to the KL ledger group, you cannot change, right? Let us create, suppose, let us assume, right? You have assigned A9 ledger to the KL ledger group also. In that case, here, if you enter A9 KL, then the system will update 4 ledgers, 0L, A1, A2, A9. So in the case of ledger groups, right, if you don't assign any ledger group, the system will update all the leading ledger and all the non-leading ledgers assigned to that company code. Then in every non-leading ledger and leading ledger, the system physically creates one document. This is the concept of ledgers in the ECC. Now, what are the additional ledgers and ledger types available in S/4HANA? So ledgers in S/4HANA, we have the standard ledgers and extension ledgers. The extension ledger, right, is the very new ledgers types and very efficient functionality from the viewpoint of reporting, right? So under the standard ledgers, you have leading ledger and non-leading ledger. Then under the extension ledgers, right, you have the extension ledgers with the standard journal entries. Then simulation ledger, line items with technical numbers, deletion possible. Then predictive ledger, line items with the technical numbers, deletion not possible, right? This we will see in tomorrow's class. I will do one thing, right? I will send the recording immediately today, download it and listen to this again, because ledger concept is very important from the interview point of also and from the client viewpoint also, because these ledgers are very useful for the purpose of reporting from the client side. That's why you have to get the clarity of this ledger concept. Then we will go for configuration. Any questions from anybody? Okay, then see you tomorrow.